Welcome to today's State and Local Tax Podcast. I'm Cathie Stanton, the leader of the State and Local Tax Group here at Cherry Bekaert, and I'm joined by Tony Konkol, a manager in our SALT group and also an attorney, to discuss pass-through entities and options and opportunities for them within the state of Georgia this year. To give you some background, we're going to be specifically talking about pass-through entity tax elections. If you have not heard about this, you really need to get up to speed. If you are a pass-through entity, an S corporation or a partnership or an LLC treated as a partnership, because there may be significant opportunities to reduce your federal taxes now that these pass-through entity elections are in play. Basically, how this works, I'm sure everyone, if you're listening to the news in the past couple of years, there has been a limitation to the amount of state and local taxes that you can deduct on your federal tax return as an itemized deduction. You are capped at only $10,000 that you can deduct. For flow-through entities, that means that even if you make billions of dollars at the pass-through entity level, because that income flows through on your individual return, any state income tax return or state income tax liability related to that return, you can only deduct up to $10,000. So that is a significant hardship really for pass-through entities that have a lot of state income tax. Whereas if you are in a C Corp form, you can deduct all your state income taxes. So there's a big disparity there. So the states have come forward with pass-through entity tax workarounds that the IRS has pretty much given a head nod to, that yes, this should work. And that happened at the end of 2020, I believe. And now we've had a flurry, or was it 21, Tony? 2020. I think that was 2020. The IRS notice 2020.
Yes, 2020-75 is the notice.
Yeah, just had to check my dates there. But that has caused a flurry of legislation in various entities to allow these pass-through entity elections. It's a zero game or zero change in tax revenue for the states, because they don't care whether the entity pays it or the individual pays it. They get the same amount of tax. So they were very quick to say, yeah, we'll enact this to help our residents so that they can get a bigger federal tax deduction, especially states such as New York and California that have very high tax rates. The federal government really kind of subsidizes some of that state tax by allowing that deduction. So they were very quick in allowing that subsidy to go back into place by enacting this legislation. So anyway, from a general perspective, you generally just make an election at the pass-through entity level. I want the tax to be imposed at the pass-through entity level, not on my ownership level, at my ownership level. And then you pay the tax at the entity level. Voila, state income taxes are deductible in my K-1 income that flow to me on my individual tax return. And then you actually get the benefit of that deduction. So that was a brief recap. But one thing to know is that each of the states are different. Unfortunately, there was no uniform legislation that all the states adopted. Each are different. They have their quirks. They have different eligibility requirements, all kinds of different things that come into play. But there are 29 states plus New York City that allow this election now. So for any profitable pass-through entities where you have a lot of state apportioned income in a state that allows a pass-through entity tax election, you need to look at this, because there will be significant benefits at the federal level if you qualify. And if you miss certain timelines, such as when an original tax return is required, you may not be able to actually make the election retroactively. So it's very important to make sure you don't miss that election date. So that was probably a longer intro than I wanted to give, Tony. I'm sorry about that. But I
feel like these take a lot of introduction, explanation of how did we actually get to this point?
Right. And if someone hasn't heard about it before, they need, that background.
Yeah.
So let's
I'm thinking as you're saying this, gosh, it sounds really easy, but unfortunately, it's just not quite that easy once you get on the ground floor and start doing these.
We were hoping it was easy, but it has not turned out to be easy. That's
as
for
I've
sure.
spent so much time in the weeds here, really in this realm of these elections for various states, I thought, gosh, if only it were that easy when we're putting it into practice. But
Right, exactly.
yeah.
So today let's talk about Georgia's election. So when did Georgia's election come into play? What are the specific nuances? Who qualifies? Let's talk about Georgia's.
Okay, so Georgia House Bill 149 was enacted in May of 2021. So with this piece of legislation, Georgia says their pass-through entity election is first available for the 2022 tax year, or for fiscal year taxpayers, a tax year beginning on or after January 1st, 2022. So interestingly enough, when this bill was passed in May of 2021, Georgia was sometimes it's really hard to track every specific date here, but I think about state number 10 who had passed some kind of workaround in response to the SALT cap of the TCJA. But yet they kind of deferred their election to 2022, maybe to be able to gear up for it and produce forms and guidance in the meantime. So it's just kind of interesting to see of how like we're really dealing with Georgia now, especially as a lot of taxpayers want to make payments before the end of the year. And I'm like, wow, this piece of legislation was passed a year and a half ago. They were only state number 10. How about that?
Yeah, we should know everything about it by now. But let me interject. You made a really good point. So to get a deduction in 2022, which is we are at December, in December 2022, if you're a cash basis taxpayer, the pass-through entity itself is going to need to make a payment by the end of 2022 to get that deduction for 2022. So that's really, really important for people to understand. If you're an accrual basis taxpayer, you may have some additional time into 2023. But so this is why it's critical kind of right now to really, really make those payments to get the deduction.
Yeah, absolutely. So right now, I mean, we're at about 30 jurisdictions. I say New York City became the first city to have an election, so technically 29 states. But now a nice round
states.
number of 30. And as of where things stand right now in December, there's 3 more states that have introduced some legislation to enact their own. But I think it's down to 10 states now that have an income tax that haven't enacted or at least introduced some type of SALT cap workaround for pass-through entities. So
who qualifies in Georgia then?
Georgia, S corporations and any entity tax is a partnership for federal income tax purposes. So all your categories of limited liability entities, but as long as they're a 1065 filer for federal income tax purposes. Georgia, interestingly, has kind of a very strict eligibility requirement for their election, though. S corps, as long as you're an S corp for federal income tax purposes, you're going to be okay there. But as a bit of a shortcut to the eligibility requirements, instead of listing out individuals, certain categories of trusts, that could be eligible owners of an entity who can elect, they just said refer to IRC 1361, the federal statute for who can be shareholders of an S corp, but for partnerships. So a lot of times trying to explain the eligibility to people, like that's an S corp, statute. No. Georgia used that, but for partnerships is a way to just say, if you could be an S corp shareholder, you can be if you're 100% owned by owners who could be shareholders in S corp, then that is an entity that is eligible to make the election. So
you can't be owned by a partnership or a C corp. You can't. So you basically have to be owned by an owner that is eligible to be an S corp owner in order to qualify.
That is correct. Okay. So if you have a partnership with another partnership or an S corp or C corporation as an owner, even if it's just a 1% owner, that partnership is going to be ineligible to make the election for Georgia.
And there comes, I guess, the opportunity. Can you do some restructuring so that you have income in an entity that's only owned by eligible owners?
Correct. Yeah. There's a possibility there of maybe bundling all the individuals into another partnership or something in between.
Now, how does it mechanically work then? How does the owner actually get a savings, and how did the owner not get kind of double taxed with regard to this election?
So one approach Georgia has taken, and states really differ on the approach here, is that the income that's taxed at the entity level is going to be that entity's Georgia apportioned income.
Oh,
And that's
okay.
going to be for residents and non-residents. So
Okay.
if the entity only operates in Georgia, there's no apportionment. All the income is Georgia source income. But in the multi-state context, if the entity operates in multiple states, it's only going to be that Georgia apportioned income for all of the owners that's going to be in the base of income that that tax is computed on.
Got it.
So for Georgia residents, it's some relief, but it kind of helps simplify the calculation there, because Georgia resident, you're still going to be taxed on all of your income in your resident state. So if only a portion of the income is earned in Georgia, it doesn't quite capture all of that income that's taxed at the individual, but it's some measure of
Yeah.
relief, I guess. Yeah.
Yeah, and that actually isn't as advantageous as some other states. There's some other states like North Carolina, Virginia, and California where you can include the entire K-1 income of a resident,
hmm
which is great from a benefit perspective. But Georgia is just not one of those.
Yeah,
Yeah.
and maybe they just wanted to have a straightforward, simple approach. And they're not the
Yeah.
only state to do it. Maryland would be another state that just does a portion income
Yes.
for all of the owners. So this is just another one of those areas where, states kind of did this or that,
Hmm.
and this is one I could understand for Georgia, then it's just a more straightforward calculation for everybody.
Hmm.
Um, the rate of tax is 5.75%, which would be the highest tax bracket for Georgia for individuals. So like many other states, the tax rate is going to be usually for a state with a flat income tax. For individuals, it's going to be just the state's individual rate or the state's highest marginal tax rate for states that have tax brackets.
Yeah.
So how they kind of claim this benefit, or at least not be double taxed on it, because ultimately the benefit is that federal deduction.
Yes.
Um, Georgia has kind of an interesting approach here where we call it income reduced method state. So another area where states kind of do one method or the other. That Georgia individual, when they go to file their own personal return, like most other states, they're going to start with all of their income. But what they will get is a subtraction from their taxable income for the amount of income that was taxed at the entity level.
Got it.
So after that subtraction, the income that remains would be just the remainder of their individual income subject to Georgia's personal tax rate. Other states take approach of a credit. So
Hmm.
on the other hand, instead of just taking a subtraction for income that was already taxed, they would still calculate their tax due at the individual level and then just use a credit, which would be in proportion to their share of the tax that was paid by the entity, to offset the amount of tax due. Just
Yeah, and
another way
that's
of kind of
similar.
getting to the same result to make it neutral and not be taxed twice.
Yeah, and that really falls in line with the existing Georgia statutes, where if an S corporation, for example, were taxed as a C corp, if they didn't make the S election in New York or New Jersey, then and they were legitimately taxed at the entity level, Georgia's provisions were you remove that income from the return. But if the individual had to file a tax return in another state and pay tax in another state, then in Georgia you would get a credit for that. So Georgia had kind of
Mhm.
both a income reduced method and a credit method, but this makes sense if they're taxing the pass-through entity at the entity level, then you're removing that income. So at the end of the day, the Georgia resident's only going to have on that Georgia return income that didn't come through the pass-through entity, and then that
Mhm.
would be the taxable income, so you wouldn't be double taxed.
Yeah, Georgia's very ahead of the game, on this one, and kind of
Yeah,
already had an infrastructure set up to
yeah,
handle it. Because for any amount of income in other states, if you're an owner of a pass-through entity, they had both a system of claiming credit for taxes paid to other states and this
yeah,
subtraction similar to their own entity level tax. So
yeah.
likewise, if that multi-state entity who's electing in Georgia, the Georgia resident uh, makes an election in another state and
Mhm.
utilizes a workaround in another state, they would not claim a credit for taxes paid to other states on their amount of income paid there, but take a subtraction for that other entity level tax.
Right,
And that's something
right.
Georgia just already had in
Always
place and
did.
was
Yeah.
always did. Yeah.
Yeah. So how do they make the election? If someone wants to do this, or if they, well, first of all, I would say consult your tax advisor. This
Of
is not
course.
tax advice on this podcast, but consult your tax advisor. But what do they do? Do they have to make an election before year end, or how do they just qualify to get this benefit?
Well, thankfully, Georgia makes things much more straightforward than a lot of other states do. They make the election on the return. So,
Perfect.
we're getting towards the end of 2022, and sometimes you wish like states would release their forms already
Oh
so we could
yeah,
actually kind of see it. But
yeah.
the election's made on the return, and
Okay, great.
maybe it'll be a checkbox or something. Yeah, but
And
something like that.
does that include an extended due date of return?
Yes, it does.
Yeah.
Yeah.
Okay, good. And so if someone said, I'm not going to worry about that this year, or don't listen to our podcast until it's too late, is there any way after the return is filed to get the benefit still, or do you have to actually make sure you don't miss that tax return deadline?
It's a one and done thing. It's not
Okay.
revocable. So if you make it,
Ah,
you could amend the return for other reasons, but this isn't one of them,
perfect.
unfortunately. Yeah. Another issue states kind of differ on. I think states just kind of want some finality in that. I mean, some allow for, a little bit of revocation window in there if you want to unwind it, but unfortunately, Georgia is just not one.
Yeah.
When you file that return for the year, just make sure that this is the route you
Yeah.
want to go or not go.
Or
So
not go. And do you make that election every year or just one time?
this is an annual election. So
Okay.
if you don't want to elect in the next year, you don't have to.
Okay.
You're not bound by it. But uh, right, it's an election made every year, and I should bring this up too. It's an election binding on all owners of the entity. So
Ah,
there's no mechanism there for individual owners to opt in or opt out to have their portion of the income tax there.
mhm,
Just a couple states allow for some individual opt in, opt out. Not too many. Georgia
mhm.
kind of joining the majority here.
Yeah. So it seems like theirs is relatively straightforward and beneficial. Oh, one thing I'll just mention too, if a partner is receiving retirement income, that
Hmm.
retirement income under ERISA is coming through on that K1, there's federal overriding federal law that only allows the state of residence to tax that retirement income. And Georgia is one of the few states that actually address this in their pass-through entity
Hmm.
tax legislation. And so if you have residents of Georgia, they're getting this type of income, boy, it would be great to include that in the pass-through entity return and get a federal deduction on that income. But I believe Georgia carved that out and said you can't include that in the pass-through entity tax base. Isn't that right?
That's correct. Yes, Georgia
Yeah.
issued some very robust regulations. You kind of wish every other state would
Yeah.
finally come out with
Yeah.
some very good guidance like this. And that is an issue that they had addressed in there. So, it's kind of an issue that you wish more states would address
Yes.
specifically, because partnerships especially is
Mm,
just something you ki- can commonly see.
yeah. Yeah.
Mhm.
So it sounds like other than the retirement issue and other than you can't include your whole K1 income being a resident, outside of those two issues, it seems pretty favorable. And then the other thing is that you can't amend, right, and go back. So the three things I guess that are not favorable is you got to make sure you don't miss that date of the return if you want to make the
Mhm.
election. It's not as favorable to retired partners. And it's not as favorable as some states that allow you to include all the K1 income. But other than that, it is pretty favorable, it sounds
Yeah,
like.
it
So,
is. Right.
yeah,
It's not, a repeal of the SALT cap, but it is some measure of relief for some taxpayers
yeah.
for some of their income at
It's
least.
certainly the ones if there's a lot of taxable income and it's a
Mhm.
lot of taxable income sourced to Georgia, very beneficial.
Yeah, and of course, if you're in a multi-state context, depending on what your business does, maybe a good time to look into your sourcing and, um,
Yes, that's a great point. If we can
yeah,
source more income to a state where you can get a federal benefit, as long as you're not increasing some tax somewhere else, it may be worth digging into sourcing because there can be a lot of gray in sourcing in the area of
yeah,
services and intangibles. And if if it's going to be taxed anyway, If there's a way to apportion it to a state that offers an election versus one that doesn't, that could be very favorable too. So yeah, that's a great
That
point.
could be a whole nother podcast
Yeah,
itself.
there you go. Yeah. Well, Tony, this was really, really helpful in understanding the Georgia pass-through entity tax elections. I think that definitely provides some clarity on how it works. So I would just say that you want to reach out to your tax advisor if you are a pass-through entity with lots of income, and have lots of income in Georgia and may qualify. So we thank you for tuning in today. Please reach out if you have any further questions on your pass-through entity tax eligibility or any other state and local tax questions. It's been great to be with you today, and thank you so much. And thank you, Tony, for joining me.
Thank you, Cathie.